All right. So, hey, thank you for joining us on this video. And this is Michael Chu. I have a good friend, Joe Siau. And so we're going to talk a little bit about reverse mortgage. And I guess, in the Valley, it is very common that a lot of folks feel like they're just like equity rich, but cash poor because there's so much demand on life that, we're spending constantly here and there. And I mean, I for one, I feel like sometimes I don't have enough cash, but sitting on a good pile of equity. So there's a lot of those questions about this, and I just want to ask Joe. He's an expert on financial matters, and so let's ask him to start. What is like basic qualifications for reverse mortgage?
Okay, great. Thank you, Michael. Appreciate your time here. And to get started, I've been a mortgage advisor for the last 27 years here in the Bay Area in Northern California. So in the process, what I have done is I specialize in reverse mortgage in the last 10 years. So I just like to go ahead and give you some background context as we go and give you some insights to how we can help you answering these questions.
All right,
So first
great.
things first is um, for my presentation here, I have recently written a book, Habits Driven is the Game Changer. It's something that I wrote in 30 days and is now published 2.5 months thereafter. And 30 days after that, it was in 4 continents already. So if you feel like I have done a good job, go ahead and pick up the book in Amazon or give me a call for this book as well. And then secondly, as I go through this, on the bottom right, I do have a reverse mortgage guide for homeowners. Just send me an
Mm,
email. You'll get a 14-page guide, no cost whatsoever to you, so that you can double check all the information I'm providing to you today. Um, Most folks, when they are looking at a reverse mortgage, really have to, be mindful of these five bubble questions that they think about, but at the same time, they really don't process it well enough. So I'm going to help you process some of these data. The first one is I'm looking to move, but I'm not sure if I qualify for a mortgage now that I'm retired.
mm,
Okay. Um, Second question that some folks think about is I have plenty of cash. I'm certain I can pay all cash for my home purchase, but is that the smartest deal?
mhm,
Right. And the third, bubble, it says, after paying cash for my home purchase, I would love a safety net, a line of credit used in case of emergency.
mhm,
But they pay cash, then they have to do a separate transaction. It kind of keeps them, obligated and more obligations and so forth. And some people are okay with that, some people are not. And then next is, I want to retire and stay in my home. How do I do that? Right? Because they have to worry about in the
mhm,
future if they have enough money for long-term care,
right.
convalescent home care, anything else. And lastly is some people, they go through life and they says making monthly mortgage payment was tough sometimes. I'm glad I don't have one anymore. So
Mhm,
now they're equity rich and just a home but not a good lifestyle. So a lot of folks start by presenting you data about how you qualify for reverse mortgage. That's not the approach I work with,
mhm,
because these are really the five questions that we want to make sure that you either have a concern of or don't have concern of first, and then drill those down and help you understand the next part, which is this. If someone starts a presentation by telling you about qualification, maybe they're not the right lender for you,
mm,
because the reverse mortgage is all about lifestyle, comparing and running the numbers, analyzing your current situation and your future situation, which will be most optimal. A lot of people get so caught up with, well, do I have title to this? Do I, am I going to lose a lot of money or
okay.
that? My kids and heirs, and I'll cover all those questions. But let's run through this math scenario so you can see the benefit or not. Okay, let's say if you rather downsize, it could be upsize. Okay, this is just an example. If you have a $2 million or $4 million home, you want to downsize to something like a $600,000 home purchase. Great, this is a great example.
Mhm,
You can pay $600,000 for all cash purchase, right? Well, the first month, first year, 600,000 out of your pocket, your money's tied up. There's no growth in it. After 5 years, out of pocket is still 600,000. 10 years, same thing all the way through. You're out of pocket 600,000 in 20 years. Some people think about, well, I'd rather make a mortgage payment. So if they want to leverage, they could do that, right? They put 20% down at a 6.75 interest rate. The payment is about 3,100 a month or 37,000 a year plus $120,000 down. After 5 years, they're into about 306,000, and 10 years, 492,000 or 864,000 out of pocket in 20 years. So
Mm.
between choice one and two, which is a better option for you? It depends, right? If you're going to live in the home less than 10 years or more than 10 years, then you kind of know which is a better solution for you. Now, put that together with the HECM, home equity conversion mortgage. Number one, you can buy a home, okay, with a reverse mortgage. On a refinance, we call reverse mortgage. When you're buying a home, we call home equity conversion mortgage. And how does that work? Well, let's look at 65% down payment. Okay. So if you're putting 65% down on a $600,000 purchase price, you're putting about $400,000 down. Guess what? What are you going to do with the other 200,000? Well, you have the 200,000. You can actually buy rental property with that. Okay, so after this, I'll run through scenario one. What does that look like? And scenario number two, after 5 years, you're still out of pocket only 400,000. What can you do with the other 200,000? Well, you can, if you don't want to buy a rental, you can establish a line of credit. What else can you do with the money? Well, if you have extra funds, you can buy long-term care insurance. If you have extra funds, you can buy annuity, or you can start planning on funds for your in-home care. Okay. Whereas option one, 600,000, you're locked in. Option two, you're making mortgage payment. Option three, it gives you a better lifestyle, more to plan with. And then, of course, the fourth option is if you think that, well, I'd rather just rent, well, $2,800 a month, 1 year, 33,000, 10 years, 336,000. And then after 20 years, you just make your landlord very rich. Okay. So which is a better option? Well, we'll define that along the way and hope you can see the progression of what makes sense for you. Again, we're not here to try to say that this is the best and final tool for what is best for you. But each person's case is different, so we want to make sure we run through the scenario that works best for you. And sometimes people say, "Okay, I'm this age, this is my property address, this is my value, this is my loan amount. Tell me, how much should I qualify for?" Well, that's also a wrong perspective to go from, because if that's the only number that you're looking at, it doesn't really help you analyze a lot of personal details. Because if people don't combine this with looking at rental or looking at line of credit or looking at long-term care, looking at annuity or looking at home care, in-home care, they're missing the total picture. Because a lot of people think that their way is the right way. I'm a financial advisor. I'm a reverse mortgage specialist. Give me the opportunity to explain how the other pieces really fits together better for you. Okay. So again, to summarize the second slide, to have no mortgage payment today and in the future, would you rather commit $600,000 of your money to buying a home, or would you rather commit $400,000 of your money to buying a home? Well, second question is, where can you live for the rest of your life at $400,000 commitment, right? Third, after your home is paid off, will you have trap equity, equity rich, cash poor? Would you rather have $600,000 trapped or $400,000 trapped, right? So to recap one more time, you can buy a home always 100% cash. You can go through traditional mortgage. You can go through a home equity conversion mortgage to purchase a home. Why? Well, you can own your home with no mortgage payment. Traditional mortgage, you have a minimum down. On a home equity conversion mortgage, you have a flexible repayment. Okay. You can make payments to the loan only if you want to. Okay. People don't understand that, because if you want to make full payment, you can make the full payment. If you want to make some payment, you can make some payment. You want to make no payments, you don't have to make any payments either. It gives you flexibility. So some people think that, well, I don't want my principal to continue growing. Well, then make the full payment. Okay. If you don't make the full payment, there's no problem with it. If you make some, there's no problem with it. If you don't make any payment, no problem. So this offers a better choice than the traditional mortgage. You're not locked into any amount of payment on the reverse mortgage. Okay. Well, why not? Well, you can leave you with little or no money left in your savings if you pay 100% cash,
Uh-huh.
right? On a traditional mortgage, it reduces your monthly cash flow that you have less cash to spend. But with a home equity conversion mortgage, the equity is less. So you have principal and interest are deferred. So when it is deferred, when you have no mortgage payment, your loan balance increases, and your loan balance increases still with no mortgage payment. And so a larger down payment require, for traditional mortgage, you need a larger down payment, but on reverse mortgage, well, but the other way, on a reverse mortgage, you have a larger down payment versus a traditional mortgage.
Okay, I'm going to ask some question that maybe
Okay.
I'm kind of jumping ahead, but can you go back to the slide where you
Mhm.
have the four options?
Yeah,
So on here, the option three, you're using assuming a purchase price of $600,000 on a home, and then this one is only 65%. So are you saying that if people downsize from whatever, they have lots of cash in hand and they're downsizing to a $600,000 home, they can put in 65% and because it's HECM, then
correct.
they can choose to pay or not pay and just have that $400,000 locked in as equity in that new home.
Correct. And based on putting 65% down, you have no mortgage payment for as long as you stay in that home. Okay. So that's the difference and that's the benefit. Because versus if you stop making a mortgage payment on option number two, you get foreclosed. But on
Right.
option number three, you stop making mortgage payment, it's fine.
So how
Okay.
does that work? I mean, is 65% something that is necessary to qualify for that kind of treatment, or is it just any amount, or it has to be over 50%, or how does that work?
Well, the home equity conversion mortgage or reverse mortgage, what they do is they look at your lifespan up to probably about 92 years old. And based on what you are purchasing on the purchase price and your lifespan, they do a calculations. And I have maybe three or four different calculators because I'm a
Mm,
broker. So I look at different investors and see which math works out the best for every one scenario. And based on that, previously, when the interest rate were lower, it might be closer to 50% down,
mm,
but because now interest rate is a little bit higher, it's closer to 65% down. After you put the down payment into the mortgage, there's no more mortgage payment thereafter.
mm. Okay.
Okay.
All right.
Okay.
Thanks.
So if I may continue and just run
Yeah,
through this
please.
scenario, and this scenario will probably help you make a little more, help make
Okay.
sense for you. Bob and Sue, age 62 years old, okay, they're selling the current home and purchasing a new home. Should they just pay all cash? Okay, or what if they buy a home and a rental property both at the same time? Okay, so the proceeds of sale from the home was used as 65% down for a HECM loan. Okay, so when you do a HECM loan, there's no mortgage payment. Okay, and when you buy a home paying all cash, there's also no mortgage payment. Okay, so zero, zero, what's the difference? If it's zero and zero, well, because if you use a HECM, you have $200,000 excess cash because you're only putting $400,000 down. Okay, so what if the $400,000, what if the $200,000 that you have in excess cash, you go ahead and buy a $400,000 rental property at 50% down, right? You have a $400,000 rental collecting, say, $2,400 monthly rental income, mortgage payment 1,400, insurance $100, taxes $400. Hey, that's about $500 cash flow back to you. So if
Mm,
you are paying all cash for a transaction, you have no money to buy a rental property.
mhm,
If you have of 200,000, if you do a HECM loan, you have 200,000 excess cash, you can actually put 50% down instead of 25% down and have a higher than zero cash flow. You have $500 cash flow in this scenario. So this is a lot better opportunity, whether you're the type of person that see that this is an opportunity, whether you like to be a landlord or not a landlord, It is just numbers that we like to show you to demonstrate to you it's a better choice. Okay, so there are a couple of scenario. This another scenario, which is if you go back to this scenario here, number one is buy a rental. Second is repositioning that to line of credit. Number three is long-term care annuity or in home care. Okay, so let's go to the second scenario. A line of credit set up today and left untouched will be larger in 1 year, 5 years, 10 years, and so on. The line of credit growth rate is equal to the HECM note rate plus 125 basis points. Therefore, a HECM with a note rate of 5% today will have a credit line growth rate of 6.25%.
Wow.
So in English, okay, meaning that if you left your $200,000, okay, into the same bucket of a reverse mortgage, okay, so you will have a 6.5% growth rate on your money, meaning that if you left it there untouched, next year you can pull out $12,500 more on a line of credit, or 25,000 2 years, 5 years, $70,000 more,
Okay.
because preset when you close your transaction, you're defining that you have a line of credit or you don't have a line of credit. If you leave the money in there, paying 100%, $600,000 cash in the reverse mortgage for $600,000 home, okay, you have a $200,000 line of credit built in that it will grow to $472,000 more in money to you in 20 years. So is this a great deal? This is an awesome deal. But do you
Yeah.
know it? Do you understand the math? Let's double check, and we can always work out the math a couple more times so that you can see the benefit. Because if you do not want to be a landlord, what other choice are there? Well, you can park the money and let it grow 6.5%. But actually, actually, that's not even the correct numbers I'm using right now. But let me just run through this math. Um, you have available funds, and the HECM, you have a negative mortgage, you have a mortgage that has negative amortization, but at the same time, whatever extra that you put into the mortgage, it continues to grow on the line of credit, or when you do.
Yeah, I did not know about this.
Yeah,
This is
so when
great.
you have the opportunity for cash out, lump sum cash out, say, hey, I'd rather not have the lump sum cash out today, I'd rather take a line of credit. If you do want to take a line of credit, guess what? It grows 6.5% better than your stock market portfolio today, right? So
Definitely today.
right. So this is an option for you to consider. Um, but the reality is, you know, let me step back. What right now, most of the mortgage rates are about 6.5% or higher. So this math I showed you earlier is actually very conservative. It's probably the math is probably a lot higher than this. Okay, but on a worst case scenario or a conservative portfolio scenario, I was using how would you like to pull out 6.25% interest rate from your home year after year? And that's a
Wow. Okay.
conservative number. Okay, you can take a home equity line of credit today with no draw. If you do not draw any money from it, it keeps growing. And the actual number is the line of credit grows at the note rate plus the annual mortgage insurance of 0.5%. So if the note rate today is at 6.5%, and mortgage insurance was 0.5% higher, it's actually going at 7%, not at 6.25%. What's the benefit? Well, you can reposition those money into long-term care, annuity, in-home care, or for any kind of emergency. So this is the part that a lot of loan officer won't have the opportunity to explain to you if all you worry about is, hey, my property value is this. I'm 62 years old, or I'm 85 years old. How much can I get on line of credit? Or well, they can't really do the full analysis for you to help you understand your math better. And by giving those data, it sometimes help, but it's like it doesn't allow them to shop around for you
Mm,
because again, being able to shop around for you takes time to make sure that all the investor that does this kind of mortgage give you the best deal, and we can run through those best deal by repetitive conversation. With this work, with this work, with this work, how does this look for you? Okay, so as a qualifier, the fine print below, it says if part of the loan is held in a line of credit upon which the borrower may draw then the unused portion of the line of credit will grow in size each month. The growth rate is equal to the sum of the interest rate plus the annual mortgage insurance premium rate being charged on the loan. Okay, so again, each year or every couple years, there's always guideline changes. So we want to make sure that we give you the best benefit, letting you know what's coming down the road. And if there's something that you should make sure you look into beforehand, we will let you know that as well. So
Okay.
skipping to the third category, which is we are all living longer than ever. Okay. On the average, someone age 65 today can expect to live age 84, 86, or even older, maybe to like 92. So the average, just was average data, was showing that you need about $266,000 for long-term care expense. Okay. So if you have the money, great. If you don't, can you kind of see how reverse mortgage can kind of position you for that extra line of credit money in, between your, next 5 years or next 10 years or next 20 years? And also, if you don't need long-term care, maybe health insurance, maybe, in-home care, maybe just planning for emergency, maybe, for someone to, pick you up, a driver or someone to help you, buy the grocery, they deliver great. Just something extra for you to have as a resource when you look at reverse mortgage.
Okay.
Did you have any questions?
I'll ask later. I'm sure I
Okay, all
will.
right. So again, my job as a financial advisor is to make sure that you are aware of asset repositioning versus just getting a quote. Okay. $200,000 and zero mortgage payment. How do you, reposition that? Okay. We talked about buying a rental. Okay. But for realtor, also be aware, instead of buying, helping your client with one transaction, how would you like to convert one transaction into two transactions? Okay. Have you, if you have a line of credit that grows yearly, okay, that's great. You can buy long-term care insurance, buy annuity, buy in-home care insurance. So in summation, I'm a fiduciary. Okay. We will serve your best interest because that's my job. Okay. We cannot do anything that will be perceived as predatory lending, meaning that if you're a senior, we also have to make sure you go through a secondary counseling first, just to make sure that you're aware of the numbers from a neutral party so that you're not being skirted in the direction that favors me, but it's a neutral position. Um, Same thing with your financial advisor. They will probably give you some opinion, but they also cannot push you into selling out your investment to buy a house, and they cannot push you into getting a reverse mortgage. They have to be neutral on their end. So what our job is, is I will tie it in with your financial advisor that we are both on the same page, that we communicate to see what is your best benefit, but we leave the decision to you because we all both need to be neutral in this situation. We cannot force you to sign certain paperwork. We cannot push you to, making a decision. We want to present the adequate amount of data so that you are making the right choice all the way through.
Okay.
Okay. So as I go on, I love doing this, because it's like the planning stuff is something that sometimes I don't get to do on a day-to-day mortgage side. So
I do have one question. I don't know if you're going to address that later.
sure.
You assume the case of selling a home and then buying a new one at lower price. But what if people are already in a home that has lots of equity? They're over 60% or 80% or maybe
Mhm.
fully paid off.
Yeah.
Do they have an option to use reverse mortgage and ease their cash crunch?
Yeah. Uh-huh. I'll go through that
Maybe
next.
later. Yeah,
Yeah.
I just
Uh-huh.
want to
You bet.
ask that.
So common question, number of them, whole lot of them. I don't want to give up the title of my home.
Hmm.
Well, on a home equity conversion mortgage, when you buy a home or reverse mortgage, when you refinance a home, your name is still on title. It does not change. Your name is on title till you die as a title holder. So, which means that, once you're on title, you can do whatever you want with your home the way it is with a current mortgage. Same thing. Okay. You can stay there with no mortgage payment. That's number one benefit. Number two, you can sell anytime and pay out the lender and keep the profit, like any home, any mortgage, same thing. Number three, if you choose to get out of the reverse mortgage, refinance. You know, when you refinance, you get into a mortgage that you have to pay monthly mortgage payment. Maybe you want to get out of the mortgage and maybe you just want to take a brand new $100,000 loan. Great. Just go get a brand new $100,000 loan. It might give you about $800 monthly payment. Perfect. Okay. Something happens to you. What happens to the mortgage? If you're on a title holder, most likely you have, you know, an estate, living trust, or you have will whatsoever. Within 6 months to 12 months, your state steps in, and typically, your state will make some decision because the bank, calls you up every 6 to 12 months to see if you are alive and well. And if you're not, then they will start sending in paperwork to double check, if you're well or not, or they will begin, what they call the pre-screening of the foreclosure process. And if no one gets back to them, then they will proceed. But your estate still has 6 months to 12 months to do exactly the same as number two and number three. They can go and sell your estate because if they are the successor of your estate, they can sell it,
Hmm.
right? They can sell
Okay.
your estate and keep the
Yep.
profit. If the successor of your estate, your kids, they can assume title and they can refinance the current mortgage and they can pay off the loan, pay off the bank. And they can always, or they can refinance and stay in the house and live there, right? And lastly is what if by the time that you live there for the next 40 years, well, the appraisal value is maybe 800, but the mortgage balance now is 1 million. Well, then if you're upside down, your estate certainly don't want to cough up $200,000 to pay the bank back. They just go mail the keys back to the bank and says, go ahead and take over the property. It has nothing, nothing will be recorded on your estate. Nothing will be recorded on your credit report.
Wow.
Nothing will go into your bucket nor your heirs bucket because
So
the
this
title
is
was
really
in just your
completely
name.
different from the normal like understanding of how mortgage works, right? I mean,
Yeah,
because they don't foreclose on you. Your title stays with you no matter what until you die.
correct.
And then it gets handled at that point. But even if it's upside down, you still have no obligation. It doesn't pass on to your heir.
Nothing, because it's in your name, and if they foreclose in your name, not in your heir's name. And, if you're upside down 200,000, 500,000, that's the whole benefit. If you're very healthy, this is the mortgage for you
Ah,
because you can outlive the bank.
so you got to outlive the statistics.
Correct. Yeah,
They
and
they go by statistics, though.
nice. So we'll show you amortization table, and you can review that with me, with your financial advisor, and see what's the best scenario for you. If you're
Okay.
healthy, this is the way to go. If you like the house that you're living in, yeah,
Finally, one way to beat the bank.
yeah. There you go. So,
It's a moral victory.
so most other people who have questions because in this economy, we have people who are living together, not married, or we have people who are, couple generations apart, and
Uh-huh.
they decided to stay with someone older. So there's a lot of questions about who is eligible or ineligible. Typically, in the reverse mortgage, 62 years old is what we want to use as a qualification, standard. But we do finance for people who are down to 55 years old now. But then, there's a
So
lot of
how does it
questions
work
about.
if one spouse is at 62 and the other one is, let's say, 58 or something? Does that work?
Yeah, that works. So let's go through these Q&As here right now, okay?
Okay.
There are a lot of questions about the role a spouse might play when applying for reverse mortgage. Luckily, there are protection in place because of HUD, okay? HUD safeguards, your retirement plan. Eligible and non-eligible spouse may not meet the loan age requirement, okay? May be legally married and living with the borrower partner at the same time of application. Okay, if they're living together, legally married, living with the borrower partner at the same time of application, must secure the property title within 90 days of the borrowing passing,
Huh.
must continue to meet loan requirement, including paying property taxes, insurance, home maintenance, and any other applicable
Sure.
costs. Okay,
I thought I saw somewhere that said everybody on title needs to be 62 and above, but it's not true then.
well, then the other part is, well, you are eligible. You can always have a spouse who are less than 55 or less than 62 years old. She's just not on title. And right here it says if you're not on title, then if your husband passed within 90 days, you have to go ahead and secure the title of the property on your
I
name.
see. I see.
Okay.
So
Or
basically, if you want to do that, then what you do is you transfer title to the qualifying spouse, and this person would be the applicant, and then the non-qualifying would
correct.
just enjoy the benefit.
Correct. So,
Okay.
and just because you apply for reverse mortgage, it doesn't mean that when your spouse becomes 62, she cannot. Yeah, she can go and apply for a joint reverse mortgage at that time as well and extend the loan further out if they
Uh,
want.
okay.
So there's some benefit in having her on title so that if you pass, she can stay in the house until she passes. Okay.
So as soon as the spouse hits 62, could be back on the title and still keep the reverse mortgage.
Right. If they go through a refinancing process. Correct.
I see. I see. Okay.
Okay, and then or your partner may be considered an ineligible spouse if they never lived on the property as a primary residence, right? Or your partner isn't legally married, then of course they're ineligible. Okay, you plan to give your home to another heir name in your will, they're ineligible. Okay,
Mm,
so if you are on title, okay, and you're legally married, okay, just because your spouse is a little bit younger, there are ways to work around that, or they take over a property within 90 days
mhm.
as long as the taxes, insurance, and maintenance is, taken care of, then there shouldn't be any problem.
I see.
Okay.
Okay.
So, what types of home are considered eligible? Well, single family home, townhome, FHA, 2 to 4 units, manufactured home that meets guideline. Benefits of reverse mortgage, okay, meaning that if you already own a home, okay, and you just want to go, you don't want to buy a new home, you just want to see based on equity of your home, how much money you can pull out. Okay. The maximum limit is $4 million. Okay. But let's say you have three choices. You can pull out lump sum if you can pull up to $4 million out. But instead of pulling all the money out, you can do what they call annuitized payment, meaning
Mm,
that they might do the calculation and says, okay, for the next 30 years, that's about $100,000 a year. Okay, we'll pay, say, $10,000 a month, every month for the rest of your life. So if you think that that's pretty good and you're very healthy, of course, that might be good because maybe you live 40 years. So if you live to 102, 40 years, $10,000 a month every month, it beats some, mortality table of 30 years. So of course, annuity payment, fixed payment every month the rest of your life, that might be a good opportunity. And then maybe you say, I want 5,000, and then the remaining on the line of credit that grows to 6.25%. You could combine any of those,
mm,
right? So any benefits comes with there's no mortgage payment once you qualify and once you pull the trigger, and this is the best scenario for you. You can take lump sum, annuity payment, or line of credit, or any combination of the three. So you can say, I want to take, $2 million out. I want 1 million to be annuitized, and I want 1 million on a line of credit. Yeah, we can do that. We can put all the numbers together and put it through underwriting and making sure that you have what you want. Okay.
huh. Okay.
Okay. So there are so many changes. Okay. Quoting a rate is different than successful closing on time, on schedule. So be patient because there's still many, many moving parts. Because as I see it, sometimes when people think that there's no conditions, we can precede, I mean, we anticipate there are a lot of different conditions coming because we've been in this industry for a while. Before in black, 62 years old, but now 55-year old are eligible. Okay, if you're able to put more down or if you have more equity. Before, you have bad credit, foreclosure, okay, but you still need somewhat of a good FICO to qualify. But now you can be like 500 FICO and you can still qualify.
Mm,
Okay, even if you have low income, you can still qualify. Okay, but you must demonstrate that you're able to pay taxes, home insurance, and HOA fees and maintain the property for the loan to close. And well, before there was something called, well, you have to have enough equity. Okay, before you have to have enough equity position in order to do the loan. Well, now there's something called a 10-year plan. Okay. Meaning that if you currently have a mortgage, okay, that is more than 10-year, okay, and let's say, for instance, you don't qualify for reverse mortgage. What do I mean by you don't qualify? Well, maybe you need to bring in $50,000 in order to gap the equity position in order to have no mortgage payment for the rest of your life, but you don't have $50,000 to bring in. Okay, so, but your 50,000 will take 11 years to pay off. Okay, there are situations like that. I'll explain to you one. We can come back with a scenario. Okay, you pay the bank, say $600 a month every month for the next 10 years, and after that, you have no mortgage payment thereafter.
Mm,
And some people are okay with that. Okay, because before they don't qualify, if they would want to have no mortgage payment, they have to put in 50,000. But now if they don't have to put in 50,000, they just have to make $600 payment for the next 10 years. Great. So a scenario comes back to I'm working with a divorced couple. Okay. I'm a certified divorce lending professional also. The husband has a $350,000 mortgage that needs to pay $150,000 to the spouse. His mortgage payment is about maybe $1,800 a month. Okay. But he doesn't qualify to take out the more money because his home is only worth about 800,000. Because his home is worth 800,000, he cannot take $150,000 out today, but his mortgage will continue for the next 10 years. So what if he continues to make the mortgage payment? Well, what if we give him $150,000 today and he continued to make the same $1,800 mortgage payment on the same math that he's making right now,
mm.
and after 10 years, he has no mortgage payment.
Wow.
Great deal.
Yeah,
It's
I
a
mean,
product, it's a program that was never available before. But now it is because how we are restructuring it, okay, you mean I can get $150,000 out of my house and I'm making the same mortgage payment as I was before I got the loan? Yeah. And then if your intent was that you want to, not have a mortgage payment after 10 years, like you want it not to have a mortgage payment, yeah, perfect. So there are different equity position. If you have low equity positions, some lender would obviously say, no, you don't qualify. But we have investors now that are able to do that if you have at least 10 years of mortgage payment remaining and you have 680 FICO or above. And if those two are there, then we can put it together. So there's just so many moving parts. And before, the mortgage cap on the reverse mortgage is about $970,000 for FHA limit. Now it's up to $4 million for conventional style with no mortgage insurance.
wow.
And though I also have resources that can go to 4.4 million, I also have resources that might be go to 5 million as well. So, but for simplicity's sake, you know, yes, run the numbers. Happy to help you run the numbers. We'll give you some structure of what to ask your financial advisor. We'll give you some opportunities to look at which area you can reposition your asset and that you can see, the full framework and what's beneficial for you. So now is a good opportunity here to answer some of the previously questions that you provide to me. Okay, Michael, let me see if I can capture some of those.
Actually, let me ask you one more
Okay.
before that.
Mhm.
So if this is such a great deal for people over 62, why is it like not everybody converting to this? What's the catch from a consumer standpoint that they're like, oh, reverse mortgage? Why there's such a stigma? Is it just not being publicized, or what's the thing that's holding people back on this?
I can think of several. One is just the misconception and the myth that you don't own your home anymore after you sign up for this mortgage, right? And
Right.
people, if they don't ask the question, they don't drill down on the question. No, the title is still recorded in your name. You're not giving up your home. But previously people think that you give up your home because they think that bank is going to foreclose if you die. Yes, 30 years later after you live in the home for 30 years, right? So if you don't make your mortgage payment, bank will take over your home. This, you don't have any mortgage payment, you're not obligated, but you have to disposition your home 6 months or 12 months after you deceased, and your state and your heir has to do something with it. If not, then the bank will take over the home. So that's a myth that people sometimes have concern, but when this is properly explained to them and it's all in the documentations that's provided in disclosure, um, and it's a contract, okay, it's a business contract that you have with the bank that they will not foreclose on you, okay, then people feel a little more comfortable. Another myth or consideration could be, uh, I don't know, some people think that, well, I'm gonna have to sell my house in a couple years anyways to move in a convalescent home. Why should I do this? Well, that's a valid reason, right? So if the math doesn't make sense, we'll show them how much the principal is increasing, and they can make the choice of saying, yes, this makes sense, or no, it doesn't make sense.
Hmm.
Because to some people, if they were locked in on a 2.75 interest rate last year, okay, and now they see that the home equity conversion mortgage with no mortgage payment is at 6.5%, they might not think this is a great deal. But some people with no cash available in their hands, and they can, and they don't have a job to qualify for a standard mortgage, this might be great for them because they don't
Right.
need to show any cash and they can pull out $2 million overnight. You know, if you want to pull out $2 million from your home, you might need to show maybe about four or $500,000 monthly income. If you can't show that, how do you pull out $2 million from your house? And if you do pull out $2 million from your house, yeah, you also have a 7% interest rate. Can you afford to pay that payment, right? So this comes to be a math question, an emotional question, something that you want to plan. What are you going to do with your cash? And how do you outlive your money? When inflation, give us so little left. So how do we do more with what we have? So those are maybe top three consideration of people willing or not willing to look at this mortgage.
So, I mean, I don't fully understand, like not 100% yet on this, but let's say, it's got all of these benefits. So one more thing is, what's the difference between this one and a regular mortgage on loan origination? How much fee do people have to pay to get into this?
Okay, well, that could be a deterrence for some people. Um, our bank fees are basically 1 to 2%, but it's all capped based on FHA requirement and or capped by the investors. It's not the same as, many years ago where people make a lot of money from it because of the competition level. There's a lot of people providing the same service, and at the same time, it's the numbers. If the numbers does not work for your client, it does not work, whether if it's 1%, 2%, 3%, or 4%, commission that is earned from this, or origination fee that's, quoted, and or some of the margins or the index, because there's so many different programs available. There's adjustable fix, and there's also what we call life expectancy set aside, so that this way people do qualify when they actually don't. So if they actually don't qualify, how do we qualify them? Higher interest rate, higher fees. So some of those will be explained to them. And at the same time, people may or may not be comfortable with it. So that's always a deterrence. But when people are short on cash and they see this as a benefit, they can see how much further they can go, with this benefit than not having this benefit.
Yeah, I think the difference really is, for people in a certain bind, if they are looking to have some cash to spend
Hmm.
and they don't see that happening. I mean,
Hmm.
at 62 and over, for a regular person, you don't see your earning power to go up. So
Hmm.
if that doesn't happen and they're still in need of cash, and originally they thought they had no option or very
Hmm.
little option. Now here comes along something else, and fee might be a little bit higher than a regular mortgage, but you don't have to worry about mortgage payment, monthly payment
Exactly.
after this.
Hmm.
So that takes a lot of pressure away from
Hmm.
people who wants to hang on to their home.
Exactly. Yeah.
Okay,
Okay.
great.
So some of the questions that you had asked previously is,
Okay.
how many appraisal? Well, typically, if it's less than $1.5 million home value, is one appraisal. Over 1.5 million, typically could be two. Um, the borrower passes away before all the equity, what happens then? Well, they can sell or they can refinance. What if borrower wants to sell the house? They're okay to sell the house. Is it possible to pay it off sooner with no penalties? Yeah, okay to pay off, no penalties. So you have a regular mortgage, they can foreclose for you for non-payment, but borrower can stay in the house even when there's no more equity. Correct. They just have to pay taxes and insurance. Um, Outliving the payout, then what? Well, annuity payment is guaranteed for life, never outliving any payments. So if you're taking a annuity payment, yeah, you just keep taking the money, until you die. So it's a good opportunity for that. If there's no more equity and borrower homeowner decide to sell, the commission will be out of pocket since it will be junior to the lender. If there's no equity, just mail the keys back to the bank and let them foreclose.
Right.
Okay.
Okay.
And then from application to funding, what is the typical time frame? It's about 21 days for purchase and about 30 days for reverse mortgage. Um, and then the the calculations is basically determined to maybe life expectancy of 91 years old. And sometimes they go to 87, sometimes they go to 90. So it's between the 87 and 91 year range, when they underwrite. And then typically a year or two ago, it's about 50% equity is required or down payment is required on the purchase. But now it's about 65% equity or 65% down payment is required for this program to work. And then just because it work in one scenario, if someone has a different credit score, like 500, and they have no jobs, the scenario might be a little bit different. So just kind of preface you on that. So two more examples I'd like to run through so I can answer the tough question that you didn't ask earlier. Um, okay, so if Jack and Karen, age 80, want to purchase a $7 million luxury home, should they pay all cash, right? So HECM requires $4 million down, okay? So what can your client do with $3 million excess cash? Right? So can they buy or can they refinance? Yeah, if they want to pull money out, yeah, they can pull money out. They can pull about $3 million out. So overnight, this is
Hmm.
a snapshot. Is it applicable to all people with a $7 million home? Around that range, okay? Not 100% accurate because you might be 65, you're not 80, right? You might, not be able to afford paying your property taxes because we have to show that you have the capacity and capability of making property tax payment. Because your property tax payment, might be, I don't know, 50 to $70,000 a year. If
Uh-huh.
it's 50 to $70,000 a year, that might be about, I don't know, 5,000 a month in income that you need to demonstrate you can make $5,000 tax payment per month. If you can't demonstrate that, then the rate goes a little bit higher and or making some adjustment with lower cash out to see if the math works out for you. Again, it's a conversation that we need to have back and forth with the underwriter. How do we adjust this so that it works for the client? How do we adjust this so that the bank will underwrite and be comfortable with the position that they're lending so that this will work for you and compliance the same with all borrowers, okay? Another scenario would be you know, for folks who are real estate minded, this helps them out. Okay. Um, VA is one of the financing that you can do cash out with no mortgage insurance. Okay. You can do no mortgage insurance financing, maybe to fund 95%. So for $455,000 home, you might be able to pull 432, 250 loan. Okay. But if they originally owes the bank 110,000, they can only pull out about $320,000 cash out. I'm using these low amounts just so you can see the difference of math, high or low. $320,000 cash out would require $2,800 mortgage payment at 7% interest rate. So $2,800 mortgage payment for 30 years, okay, is on the new mortgage. Okay. The current mortgage payment, let's say, is at 1870. Okay. If they're going to pay $1,000 more to pull out $320,000, is it worth it? Okay, well, what are they going to do with the 320? Well, the 320, they were going to buy a rental property and they were going to pay all cash. So if they were going to pay all cash for $320,000 rental property, maybe they collect $1,800 rental income. So that represent $1,000 in negative cash flow.
Hmm.
They're paying $2,800 now. Before they were paying 1,870. That's $1,000 in negative cash flow. Okay, so as a result, in 5 years, they have $60,000 negative cash flow. If if you do a reverse mortgage here, okay, you have no mortgage payment, which actually means that you have a positive 1870 cash flow. People always forget about that. If you originally have an 1870 cash flow payment, if this goes from 1870 to zero, you have 1870 positive cash flow. So that equates to 112,000 of payment that you don't have to make.
Hmm.
If you don't have to make that payment, and based on the reverse mortgage, you also get around a $45,000 line of credit that in 5 years grows to 61,000. So you take the 61,000 plus 112, that's about $173,000 that you come away with as a positive benefit in 5 years.
Hmm.
Plus, if you were going down to this path and sinking your money in a negative cash, you actually came out $233,000 net benefit for not doing a regular conventional cash out refinance, thinking that the conventional cash out refinance, leveraging the cash to buy rental property, that this is a better situation than it is to go ahead and do a conversion mortgage and not to do a cash, and then just saving money because you now have positive cash flow, getting a line of credit. So the math just works out a lot better when someone's able to sit down and explain to you and run the math for you. You're going to do A or B. What's the benefit? What's the cost? We go straight down to numbers. How is this going to be hurting you or helping you? Would this help you or would this hurt you? Let's
Yeah.
just look at the numbers. So in this scenario, don't take out cash to buy rental property. You can go a lot further doing home equity or reverse mortgage, not buying a property, and still be a whole lot farther ahead in financial planning.
Listening to this, I feel like reverse mortgage is not something that you do when you're like out of options. This actually could be a financial tool to help you get into something else.
Yep.
Okay.
Yeah. And I think for the inflation right now and the stock market crashing so bad, some people really need this tool to help them get from point A to point B, because otherwise, they can liquidate the house, they can liquidate everything. But why? If you don't have to liquidate, this could is a good tool to help you, you know, have some peace of mind, take a breath, just relax and making sure that the numbers work for you and see if this benefits you short term or long term. Because in a dire straight situation, there's three ways to tap into equity, right?
Hmm.
So one is you can downsize, you can sell your house and move, okay, and you have to pay commission selling expense. The other one is you go ahead and make something bad to even worse by getting a line of credit. You have a mortgage payment on your home now, and now you're getting a line of credit, you're getting
Just
another
add one
mortgage
more. Yeah.
payment on top of
Okay.
your home, right? So then you instead of having one mortgage payment, you now have two mortgage payments. So that's where home equity conversion mortgage comes into play. Again, it was 62, now 55. Okay. You can buy, you can use this to leverage to buy more depressed real estate and let it grow and help you out. Or you can use this as a way to supplement your retirement planning with your financial advisor. And, with me helping you run some numbers preliminary and see if this is still in the ballpark or not. So there's a lot of benefits if you're open-minded, whether you're in dire straits situation
Yeah.
or when you just want to use this as a planning tool before you have to get in that state. So again, happy to share with you my book. It's available on Amazon, about my 40-year career history and what I have done. And this is a book now I'm helping a lot of teenagers because the next generation matters, in my opinion. So putting this book to a lot of high school, to charities, to foster children and the single parents to help them help the kids. So I'm basically pretty much done. And if you're still interested in the reverse mortgage guide for homeowners,
Yeah, I
contact
definitely want to
me.
see
You'll get a
that.
free copy. Okay, I'll email you a copy for that. Yeah.
Yeah. I mean, I'm actually thinking along what you were saying. It's almost like if I just put out some kind of notice or ad like, "Oh, are you 62 and over? Do you want to get rid of your mortgage?" And people say yes and yes, then, this is like a whole class they could take and go,
Yeah.
"Oh, wow, I can do this, I can do that." I didn't know
Yeah,
these options were.
basically it. Yeah.
Yeah.
So again, we're here to offer information. We're not trying to sell because people who are at this age, we have to be very, very sensitive that we're not pushing something down your, the knowledge
Well, no,
gap,
I'm just talking about like
Right.
providing education so that they're
Correct.
clear that they have option.
Mhm.
Decision wise, it's really up to themselves, right?
Right.
But I
Yeah.
think many people, because my impression of a reverse mortgage actually was a little bit more negative. I thought it was
Mhm.
a last resort, and when people are in that equity rich but cash poor position, and they
Mhm.
really want to move forward in life to actually enjoy something or being able to get rid of the mortgage payments so they don't have to worry about it with the declining income and all that.
Mhm.
I thought that was the only case that it was applicable, but per your explanation, I think it's more like a financial tool that people can use to
Mhm.
continuously invest.
Yes. That's how this works. And, if we're all open-minded, taking one more, question, receiving one more answer, sometimes it just opens up, your whole world.
Okay.
Whereas you were kind of, closed and frustrated, now you see a lot more hope. And
Yeah.
that's what we try to offer, it's something that's worth investigating. And down the road, something might click and, give us a call, give us the opportunity to work with you because when people do take advantage of this, they just have so much more peace of mind,
All right.
and that's what we're trying to share.
All right, there you have it.
Mhm.
Joe is the expert, and as you heard, he has a booklet on the reverse mortgage guide. I will be getting a copy and definitely kind of study that myself more. But for you out there, if you are approaching 62 or uh, already there, and you're looking for options about home mortgage, it's just getting too heavy, and you want to find options to get out of it, or somehow get this so that it's not so stressful. Joe is a guy, and we can hook you up and do some consultation and have you educated before you make any decision. So, Joe, I wanted to thank you for all these financial matters education. I think I would just come up a few more topics and we can talk more like this,
Mhm.
and I'm sure viewers will find it interesting. So, thank you so much. I will come up
Welcome.
with something next time. If you want to have some parting comments.
Okay, I'm fine, but thank you for opportunity, Michael. And I know you're a great realtor in your market, helping folks. So I look forward to working with you again and again.
All right, thank you.
Okay,
All
all
right,
right.
goodbye to everyone. See you guys.
Okay, bye bye.